Welcome to Griffonomics. So today we are doing a deep dive into a company that, well, you probably just think of as a standard gym chain.
Right, a place with treadmills and some free weights.
Exactly. But they are quietly building this wild reality where your landlord is literally also your doctor, your personal chef, and your fitness trainer.
Yeah, all existing inside this single kind of velvet-roped luxury compound. It is a massive shift.
It really is. So we are going to look into Lifetime Group Holdings, ticker symbol LTH. Our mission for this deep dive is to explore their fundamental strategic inflection point.
Because they have completely morphed from that traditional gym into a high-yield luxury real estate and longevity platform.
Yeah, and we have a huge stack of sources for this. We are pulling from their Q4 and full year 2025 earnings call transcripts, some strategic investment reports, and a whole bunch of press releases.
Right, press releases covering their new longevity clinics, their real estate pipeline, and how they fit into this massive $6.8 trillion global wellness economy.
It's a huge market. So to really grasp the scale of what is happening here, we need to set the scene.
Yeah, I want you to mentally change the backdrop of this conversation. Like, swap out the dumbbells for sleek architectural blueprints and, complex financial charts.
Because under the hood, we aren't dissecting a fitness operator at all.
No, not even close. We are dissecting a luxury compounder.
Right. And to understand that pivot into real estate and longevity, we first have to look at the cash engine making it all possible.
The core business model.
Exactly. But honestly, calling it a gym feels completely inadequate at this point.
It really does. They operate this luxury ecosystem of over 185 athletic country clubs across the U.S. and Canada.
And the target demographic is wild. They explicitly state it's for members from 90 days to 90 years old.
Yeah, a true cradle-to-grave wellness ecosystem. And the revenue diversification is what separates them from legacy fitness chains.
Right. They are just collecting a $20 monthly fee and, hoping you forget to cancel your membership.
No, they are actively monetizing every single hour you spend inside the building.
Right, through things like dynamic personal training, full-service life spas, and the Life Cafe.
And that cafe isn't just selling pre-workout shakes anymore.
Oh, not at all. Like in their new Austin South Lamar location, they are rolling out chef-led Friday night fine dining tasting menus.
With curated wine pairing.
Yeah, inside the athletic club. Plus, they own and produce over 30 premier endurance events. So things like the Miami Marathon and the UNB Gravel Race.
Which draws in, over 90,000 global participants?
Exactly. It's basically a cruise ship on land. You board the ship, and every amenity is designed to capture a share of your wallet.
And the financial results from their fiscal year 2025 really prove that this cruise ship model is highly resilient. I mean, they reported a record year.
The numbers are staggering.
Yeah, we are looking at $2.995 billion in revenue.
Almost $3 billion.
Right, which is up 14.3% year over year. And their adjusted EBITDA, so essentially their cash profit from operations that hit $825 million.
Oh, wow. And their balance sheet is incredibly healthy, too. The reports show their net leverage dropped to 1.6x.
Which is fantastic. And just for context, for anyone unfamiliar, net leverage basically measures how many years it would take to pay off all your debt using your current earnings.
Right. So dropping to 1.6x is incredibly low for a company that physically builds massive real estate.
Yeah, it's well below their 2.0x target. And that gave them so much financial flexibility that the board actually just approved a $500 million share buyback program.
But, here is my pushback on all of this. Gyms are notoriously fickle.
Oh, totally. Massive churn.
Right. The industry is prone to churn, economic downturns, and, people simply losing motivation in February. So how are they generating this bulletproof cash flow in such a volatile sector?
What's fascinating here is a concept they are executing flawlessly, which we can call yield arbitrage.
Yield arbitrage. Okay, break that down.
So let's look at the underlying numbers. At the end of 2025, their average monthly dues reached $223, which is up almost 11%.
Right.
And their average revenue per center membership hit an astounding $3,531 for the year. Plus, member utilization actually surged to an average of 12.5 monthly visits.
Okay, let's unpack this, because you're saying this massive yield arbitrage wasn't achieved by just packing more people into the clubs.
No, paradoxically, they are making more money by letting fewer people in.
It is the ultimate velvet rope strategy.
Exactly. The yield arbitrage comes from the delta, the price difference between what legacy members pay and what new members pay.
Oh,
Right.
right, because someone might have locked in a rate of $70 a month a decade ago.
Yeah, and as those older, lower-priced legacy memberships turn over, or as Lifetime strategically raises those rates market by market, they capture a massive spread.
Right.
CEO Bahram Akradi actually noted they captured a $19.5 million monthly revenue delta simply by bringing current rack rates up compared to those old legacy dues.
Wait, 19.5 million a month? Just from rate changes?
Just for rate changes.
That is wild. So they are actively kicking people off cheap plans, allowing total headcount to drop, and yet their revenue is skyrocketing.
Yeah.
But that seems counterintuitive if you just want to drive top-line revenue, Why artificially limit your customer base?
Well, it is a concept known as intentional scarcity, and it represents Club Economics 2.0 for Lifetime.
Right.
In the past, a legacy club might have targeted 4,500 or even 4,600 memberships to be fully optimized.
But not anymore.
No, these new clubs they're building are specifically modeled to cap out at 3,700 to 4,000 memberships. By capping memberships and charging a premium, they protect that luxury experience.
That makes total sense. I mean, if you are listening to this and you're paying $223 a month, you definitely do not want to fight for a parking spot. You do not want to wait in line for a squat rack or a cold plunge.
No, and keeping the headcount lower also significantly reduces the physical wear and tear on these massive, 90,000 square foot facilities.
Which saves on maintenance.
Right, and the financial strategy is clearly working. Akradi pointed out that new clubs are opening and ramping up faster than ever before.
Yeah, the transcripts mention some clubs are reaching contribution margin positive status in their very first full month of operation.
Which is unheard of.
And just to clarify that, for you listening, hitting contribution margin positive in month 1 means those membership dues are already covering all the variable operating costs of the building.
The staff, the electricity, everything.
Right. Usually that takes a standard gym up to a year to achieve.
Yeah. And by eliminating discounted third-party fitness programs in these new clubs, they're curating a highly engaged, highly profitable member base.
People who stay longer and spend more in center.
Exactly. Plus, they're using technology to feed this ecosystem. Their AI-powered app, LAIC, currently has about 3.3 million digital subscribers.
And they use that digital footprint as a funnel, right, to convert app users into high-margin physical members.
Yeah. So with fewer, higher-paying members actually in the building, Lifetime has to maximize the revenue generated per person. They can't just rely on monthly dues.
Exactly. So they are capturing the exact mega trends disrupting traditional fitness right now, which are weight loss medications and longevity.
Yeah, this is a huge pivot.
Here's where it gets really interesting. When the Ozempic and GLP-1 wave first hit, traditional gyms panicked.
Oh, absolutely. The fear was, if an injection helps you lose weight, why would you ever go to the gym?
Right. But Lifetime looked at that and realized, okay, people on GLP-1s might not need a treadmill, but they desperately need gut health, muscle preservation, and longevity protocols.
This raises an important question for you to consider about the broader market. How is the definition of wellness shifting?
It's a fundamental change.
It really is. We are moving rapidly away from purely aesthetic, mere muscle fitness and moving toward internal metabolic health.
Because the biological reality of GLP-1 medications is that they significantly slow down digestion, right?
Yeah, which can cause severe gastrointestinal issue. And the rapid weight loss often includes a dangerous loss of muscle mass.
So instead of fighting the GLP-1 wave, Lifetime is basically monetizing the side effects.
Exactly.
They leaned heavily into something called fiber maxing. To combat the slow digestion, they aggressively market their proprietary LTH shift fiber supplement right inside the club.
And they offer a 14-day gut health reset called DTOX.
Right. And to address the muscle loss, they heavily promote personalized, protein-focused coaching to help these members maintain lean tissue while shedding fat.
They basically created a support ecosystem for a pharmaceutical trend.
It's genius. And they are taking that medical wellness pivot even further with their MIRA longevity clinics.
Yeah, they're rapidly scaling these. They expanded from 2 initial locations to 7 or 8 recently, with the explicit goal of making them accessible in every single market.
And you don't go to a MIRA clinic for a basic massage.
No, you go for a metabolic code blood work assessment.
Yeah, they literally physically draw your blood, test your hormone metabolism and blood sugar balance, and then provide targeted longevity treatments like peptide therapy and IV drips. It creates total ecosystem stickiness. I mean, you don't go to a separate lab for blood work, a pharmacy for supplements, and a boutique studio for a workout.
You just do it all at Lifetime.
Exactly. But keeping these high-paying members entirely inside the ecosystem means they also have to capture fitness fads so members don't cancel and join a specialized boutique studio.
Right, and right now the biggest threat and opportunity is Pilates.
Oh, Pilates is huge right now.
Yeah, and Lifetime is actually the nation's largest provider of traditional Pilates. So to ensure members don't leave for some trendy startup, they are innovating on their own floor space.
They are rolling out a program called CTR, right?
Yes, it is a 45-minute, highly athletic, progressive resistance reformer class.
And apparently it has already become the most waitlisted class in company history.
It's crazy. They're expanding it to over 60 locations by year-end just to absorb that cultural demand.
So they have this incredible cash-generating machine. High dues, intentional scarcity, longevity clinics, Pilates whitelists.
But all of this cash is really just the fuel for their ultimate transformation.
Right. This is the core of the strategic inflection point, where they pivot from a fitness operator to a wellness real estate developer.
The real estate engine is the actual foundation of their long-term growth thesis.
Because they have an accelerated pipeline for 2026 and 2027 that includes up to 28 new clubs.
Yeah, just to put that in perspective, they are nearly doubling their new square footage in 2026 compared to prior years.
We're talking massive new footprint locations in places like Austin, South Lamar, and West Cary, North Carolina.
But it's not just athletic clubs anymore.
No, they are transitioning to a wellness real estate model through Lifetime Living.
Right. These are luxury leased residences integrated directly into their club footprint.
For example, they are breaking ground on the Exchange Raleigh project. It features an athletic country club, a rooftop beach club, and 250 luxury residences.
It's incredible.
It's like flipping a luxury mansion, but you stay living inside it and run a highly profitable country club out of the living room to pay the rent.
That analogy perfectly illustrates the financial mechanism at play here. It's powered by capital recycling.
Capital recycling. Let's dig into that.
So, building a 90,000 square foot luxury facility, complete with co-ed, wet suites, hot tubs, cold plunges, indoor pickleball courts that requires a massive amount of capital.
Like $40 to $50 million per location, right?
At least.
Yeah.
And if they funded that purely with bank debt, the interest payments would completely crush their operating margins and anchor their balance sheet.
So it's a classic sale-leaseback model.
Exactly.
But doesn't that just trade the burden of massive bank debt for the burden of massive monthly rent to a new commercial landlord? How does that actually de-risk the expansion?
Well, by changing the fundamental nature of the financial obligation, debt sits heavily on a balance sheet, right? It restricts further borrowing and limits agility.
Ah.
But rent is an operating expense matched directly to the revenue generated inside the building.
Got it.
So the mechanism works like this. They build the club, ramp it up quickly to generate high cash flow, and then sell the physical real estate, the bricks and the dirt, to an institutional partner.
But they stay in the building.
Right. They immediately sign a long-term lease to continue operating the club. This unlocks all the equity they just built instantly.
So they recycle that newly freed capital and use it to build the next club without going back to the bank.
Exactly. For 2026 alone, they expect a minimum of $300 million in cash from this exact sale-leaseback engine.
But I mean, building luxury residential wellness cities and doubling your new square footage in a single year, that carries a mountain of execution risk.
And massive risk.
So what are the headwinds here? Because Wall Street is always looking for the catch.
The primary headwind is execution drag. The company is projecting a massive growth CapEx, capital expenditure, of $875 million to $915 million for 2026.
Nearly $1 billion in development.
Yeah, and over half of that is actually allocated to clubs opening in 2027 and beyond. Managing that level of construction requires flawless operational delivery.
Right, because a delayed permit with a city council or a supply chain hiccup on specialized materials, that can severely cascade through their financial projections.
Totally can.
So what does this all mean for their profitability? Wall Street analysts always want to see higher margins, year after year, quarter after quarter.
True. But on the Q4 earnings call, CEO Bahram Akradi did something really unusual.
Yeah, he explicitly warned the analysts against expecting EBITDA margins to push significantly past their current 27.5%.
Right. He basically instituted a self-imposed margin ceiling.
He actively told investors not to expect an extra 100 basis points, so essentially a 1% bump in profit moving forward. That is wild for a CEO to say.
It is. But if we connect this to the bigger picture, Akradi is making a calculated defensive maneuver.
As-
Well, it is very tempting for a CEO to squeeze an extra % of profit to get a short-term bump in the stock price.
Yeah.
You do that by cutting staff, lowering the quality of the towels, or cramming 500 more people into the club.
Right.
But Akradi argued that squeezing more profit would permanently damage long-term facility quality and the luxury member experience.
Yeah, squeezing an extra % of profit by cramming more people in is like redlining a luxury sports car every day.
Exactly.
Eventually, the engine blows, the clubs degrade, and that premium velvet rope illusion is shattered. He knows that the premium member experience is their irreplaceable physical moat.
And the market actually seems to respect that discipline.
Yeah, despite the heavy CapEx and the macro headwinds of wage inflation, the strategic outlook in the investment reports rates LTH as a bullish core hold.
They are viewed as a dominant, irreplaceable physical moat within that $6.8 trillion wellness economy.
Because they have built something that is incredibly difficult for a new entrant to replicate.
Oh, nearly impossible.
Yeah.
You cannot easily secure the premium real estate, the massive capital, and the granular operational expertise required to build and manage a 90,000 square foot luxury wellness resort in a densely populated urban market.
Right, the barriers to entry are simply too high for a scrappy startup to disrupt them physically.
Absolutely.
So let's just recap this journey real quick. Lifetime Group Holdings has successfully engineered a total structural transformation.
Yeah.
They moved from a traditional volume-based gym chain into a highly curated luxury real estate and longevity ecosystem.
Powered by intentional scarcity.
Exactly, charging significantly more for fewer highly engaged members. And they are monetizing the biological realities of the GLP-1 and longevity megatrends through their IR clinics and supplement lines.
Right.
And they use that massive free cash flow to fund a capital recycling real estate engine that is literally building integrated residential wellness cities.
It's a brilliant playbook.
Yeah.
And I'm going to leave you with a final thought to mull over. Building on this idea of Lifetime Living and the Amayori clinics.
Okay, let's hear it.
If Lifetime successfully merges luxury housing, personalized healthcare clinics, and daily fitness into one closed, highly controlled loop, what does that actually mean for the future of our cities?
Wow. Yeah.
We are looking at the rapid privatization of community infrastructure. Will we soon see a future where our landlord is also our doctor, our chef, and our personal trainer?
That is a fascinating concept.
And if so, the real question is who gets past that velvet rope and who gets left out?
Risk defined. Portfolio protected.